It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Again, that's yourpersonalbank.com. Today, I need to discuss something that many people are not familiar with, and that is guaranteed lifetime income. The reason I need to discuss this is there has been a tremendous increase in the benefits that are offered on guaranteed lifetime incomes. In fact, I just did some illustrations for some folks, and the numbers are literally double or more the amount of income you get guaranteed for life than they were even just a year or two ago. Now, before we get into this further, what is guaranteed lifetime income? Well, it's often commonly referred to as a pension. Most people are familiar with Social Security benefits. If you work for many government agencies, they receive a pension. A pension basically is a income that's guaranteed for life, just like it sounds. Most pensions that people are familiar with are what are called public pensions, again, offered by government agencies typically these days. These were the type of retirements or pensions that many of our parents or grandparents qualified for and received, yet those types of benefits have nearly disappeared. A guaranteed lifetime income or pension is also known as a defined benefit plan. And really what that means is the benefit is defined. It's a set amount or guaranteed for life. And again, these are the types of the old-fashioned pensions with which many people often fondly refer to as some of the best pensions ever offered. What most people today are familiar with are what are called defined contribution plans. Your qualified plans, that's your IRAs, 401ks, 403bs, TSAs, 457 plans, and etc. And a defined contribution plan has a set contribution amount, but an unknown benefit amount. Again, most cases, the benefits that you receive on an IRA 401k type of account is unknown because it's dependent upon how much you contribute and what the indexes or investments that you've done over the years have accomplished. Now, there are significant advantages to a defined benefit plan or a pension. The primary one is that, one, you know how much you're going to receive, and two, you cannot outlive the money. And why that is so important is study after study for decades has shown that the number one concern of retirees is running out of money before they run out of time. And historically, people continue to live longer as medical advances occur. And the other common denominator is most people, statistics and studies show, underestimate how long they're actually going to live. They also underestimate the impact of things like inflation, healthcare costs, and etc. A guaranteed lifetime income can alleviate many of those concerns. For one, you cannot outlive the money. Again, it's guaranteed for life. Now, like I stated earlier, there has never been a better time in my career over 25 years to establish a guaranteed lifetime income. The amounts of income you can receive based on contributions are literally more than double than they were even just a year or two ago. In fact, I can give you examples where we have companies that will offer you a 30% bonus up front first year on your money. Therefore, your benefit or the amount of money you could have received has increased by 30%. We also have companies that, for example, pay a 20% bonus and then guarantee the benefit will increase by 10% each year that you defer until you decide to turn it on. These are significantly huge numbers. For example, if you choose the 30% option, for example, and then it guarantees an 8% annual increase in your benefit each year you wait, what does that mean? Well, if you put in $100,000, for example, your benefit obviously would be $130,000. That would increase by another 8% the first year, guaranteed. So the amount of money you have set aside for supplementing retirement, let's say, would increase about 40% in 1 year. That is massive. How many people realistically expect their investment portfolio to increase 40% in a year? And folks, this is guaranteed increase. This is why it's so significant. The other thing about it is the amount of income you receive is dependent upon the amount of money, of course, how many years you defer, and what your age is when you turn on the income stream. This is one of the few cases where being older is beneficial. I often talk to people all the time about investments. Obviously, being younger and compound interest in time are a major benefit for somebody who's younger. A guaranteed lifetime income is the opposite. The older you are, the more income you're going to receive because it's an actuarial calculation in terms of how much you'll receive each month or each year. Again, guaranteed for life. And the older you are, the shorter your life expectancy, obviously, the more money you're going to actually receive. If you're listening or you know of someone who's concerned about potentially running out of money in retirement, I'm going to encourage you to contact me at yourpersonalbank.com. The information I need is very simple. I would only need your age, the amount you're considering funding, or the income that you need. I can reverse engineer it, and when you want to start the income. Some will allow you to start income day one. Everything is guaranteed. Everything is locked in. Doesn't matter what the economy does in the future. Again, it's guaranteed for life. The only moving part or changing amount is when you start the income. That's not a decision you have to make immediately. You can decide to start or stop income payments at any time. We call it an income stream. It's like turning on or off the faucet. And the longer you wait, the bigger the check or the income that you would receive. Again, guaranteed for life. I've accessed over 50 companies that offer these types of accounts. We deal with A-rated, A-plus rated companies. And I can compare. I've got a computer program that will run the numbers. Again, if I have the amount, your age, and when you plan to turn on the income, and we can spit out the top 3 options for you. If this is of interest, again, contact me at yourpersonalbank.com. We're going to put something on our website for requesting a guaranteed lifetime income comparison. But until we get that on our website, it might take a few days or a week or so. Just contact me. I'll run that for you. No cost or obligation. This is the best time in over 25 years for these types of accounts. What can some uses be for this? These are a tremendous option for IRA, 401k type of accounts, qualified plans. Why? Well, an IRA by definition is an individual retirement account. It's designed to supplement retirement. When you take the funds from the IRA, they become taxable. Therefore, it's unlikely in any given year you're going to want to take out a large withdrawal. If you do, you're going to get hit with a large tax bill and even potentially increase or jump to a higher tax bracket because of the large withdrawal that particular year. So again, IRAs, 401ks, qualified plans are designed to supplement retirement over time. For most of those types of plans, at age 72, you're required to take a minimum amount. It's called a required minimum distribution, or RMD for short. And so for a gentleman I just met with, he's 73. He has an RMD with his IRA. We calculated the amount of money from his IRA he needed to roll over into a guaranteed lifetime income. No cost, no fee, no tax. It's a non-taxable event because of being a rollover. And then this guaranteed lifetime income will start generating that amount of money, his RMD requirements, guaranteed for the rest of his life. This is super powerful because each year he's going to have to take money from this account. Might as well guarantee that the money will be there to do so. He also decided he liked the idea of having guaranteed lifetime income a little bit later in life. He's very healthy. He's in fact written a book on eating right and various things such as this. So it's highly likely this gentleman is going to live for a long time. So longevity insurance or not running out of money is of concern, as it is for many retirees. So we determined how much he needed to fund and roll over into a guaranteed lifetime income, the best company possible, the biggest numbers possible, to receive the required minimum distributions guaranteed for life. Then he's putting the remainder of the funds into a second guaranteed lifetime income that he plans to defer for another 5 or 6, 7 years potentially. And each year that he defers that payment, the amount he will receive increases. Well, this is a great way to offset future inflation, for example. Yet guarantee that that money will be there, that income will be there when he needs it. Isn't that the purpose of retirement accounts? The primary purpose of investing for most people is to ensure that you have money to supplement retirement by allocating at least a portion of the portfolio to guarantee that you will have the money you need to live on. Makes a lot of sense. That guarantees you'll never run out of money in retirement. I've been sharing on this show for a while now, and I'll discuss this more in the next segments of the stock market has seen a tremendous run up in the last couple of years. For many reasons, unlikely to see that type of gains in the next several years. So it might be a good time to take some of those winnings off the table and perhaps put it in a guaranteed lifetime income account. You could receive as much as a 30% bonus up front. If you want to wait a while to turn on income, you can receive a 10 up to 10% guaranteed increase of your benefit annually. Most people do not expect 10% increases on their investment accounts, the available monies year after year. You can receive that guaranteed through a guaranteed lifetime income benefit. Again, the idea is to make sure the money is there and you receive an income that you cannot outlive. If you want more information on this, contact me at yourpersonalbank.com. I'll be happy to run a no cost or obligation comparison of access to over 50 companies. I will show you the top 3 or however many you want to see and show you the best options. The only information I would need is your age, the amount you're considering funding, and when you want to start that income. And I can show you which company, which product will generate the highest amount. And I think you'll be quite surprised how much you're going to receive. Stay tuned in the next segment. We're going to discuss some things about what the stock market is likely going to look like for the next decade.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Over the past year, and I would see periodically a few articles sharing concerns about the future returns of the market, what to expect, and that has gradually, slowly been growing and building, much like a wave. And this wave has continued to grow and build so that it's more like it's gradually grown into quite a large wave. And at this point, it's getting to become literally like a tsunami. You almost cannot find a positive article now projecting strong stock market returns going forward. And there's several reasons behind this. One of them, for example, this Yahoo Finance article that states from Motley Fool, the stock market is doing something it has done only 2 times since 1985, and history is clear about what happens next. Now, the interesting point about this article is it points out that the index year to date in 2024 has returned about 27%, which is one of the strongest performances in the last century, the S&P 500. In November, the Conference Board survey found that over 56% of U.S. consumers expect the stock market to rise over the next year. And while they may seem like good news, Morgan Stanley sees it as the opposite. This indicator is showing irrational optimism at a time when valuations are already stretched to extremes. And they go on and point a couple of reasons why, and it's very informative. As they state, the S&P 500 is historically expensive, currently has a forward price to earnings ratio of 22, which is a premium, and it's not been this expensive over 22 except for 2 times since 1985. The first time that the S&P 500 forward PE ratio was above 22 was the dot-com bubble. It hit about 22, in fact, and then in 2000, the S&P 500 declined 49% from the peak of March 2000. The second time that the forward PE ratio topped 22 was during the COVID pandemic, and the S&P eventually declined about 25% due to higher inflation and various things like that. They go on to explain that the forward PE multiples are prone to inaccuracies because they're based on earnings estimates. But, as they state in this article, current PE ratios, which are calculated using the trailing 12-month earnings, price to earnings ratios, often are far more accurate because it's measuring what's already happened versus what's predicted. As they point out, the current PE ratio for the S&P 500 is over 28. Now, this is one of the highest points ever. And as they point out, in fact, if you go back to 1990, the S&P 500 has never, and I repeat, never generated a positive 10-year return after the current PE ratio exceeds 25. And again, we're at 28 times. Stocks are trading at 28 times the price to earnings ratios, or 28 times of what typical S&P 500 company earns in a year. This is why Goldman Sachs, Blackrock, JP Morgan, analysts have all come out and stated that they predict the S&P 500 to generate a total return of about 3 to 5% annually over the next decade. They go on to state that is below the long-term average and is quite a gloomy outlook, but it is primarily because of the price of the S&P 500 stocks being so extreme. If Goldman Sachs, BlackRock, JP Morgan analysts are correct, and the stock market does indeed, the S&P 500 averages 3 to 5% annually over the next decade, fixed assets are going to outperform that. Your personal bank policies currently pay 6% insured with guarantees, tax-free, highly liquid, and dividends are on the rise. Historical averages are around 7%. Would you rather receive a 6 to 7% tax-free return with guarantees insured, or 3 to 5% return with the stock markets, with the S&P 500, let's say, again, assuming these analysts are correct, with risk? And wouldn't that be ironic, where you took on the risk and got a lower return? And some people think that's crazy. Well, if you look back through history, it is not. In fact, we had the period, as they pointed out, after the dot-com bubble of what was called the lost decade. 2000 to 2009, if you had invested in the S&P 500, it would have taken you a little over 9 years to just get back to even. We had a 49% peak to trough drop and then recovery, which generated what was commonly known as the lost decade. Over the last 120 years, there have been 6 lost decades in the stock market. If you look historically speaking, about half the time the markets go down or stay relatively flat, and the other half of the time they go gangbusters. And the points these articles are trying to make is, hey, the markets, no question, have had historical strong returns over the last couple of years. And as this next article points out and states from CNBC, the S&P 500 is up nearly 30% for the year. Don't expect such high returns to continue. They go on to point out that it's important for investors to temper their expectations and to remember that years like this are rare. In fact, incredibly rare. The growth of this past year is way over the average, and it would be highly unusual for that to continue for a multi-year time frame. We have had the past 2 years over 20% annual returns. The return that we saw this past year has only occurred 17 out of the last 74 years. And multiple years in a row of significant gains are even rarer. In fact, this is only the third time in the past century that we've seen back to back years of over 20% in the history of the stock market. I do not believe that there is a 3-year period that we saw 20% returns 3 years in a row. And they go on to point out in this article where there's a tendency to expect recent performance to continue. They call it recency bias, what has happened recently, but reversion to the mean is statistically far more likely. So again, we have had 3 times in the past century where we had back-to-back 20% increases in the stock market, S&P 500, various things like that. Never has there been a 3-year period of 20% returns. Tempering your expectations going forward is the prudent course. Ironically, depending on which option makes sense for you, you could take some of these winnings off the table and reallocate to a guaranteed lifetime income to create some future income that you cannot outlive. And we have companies that are paying 20 and even 30% bonus upfront first year with an 8, and some of them even offer 10% annual increases on your benefit amount. So ironically, you could have been invested in the market, made some tremendous gains, decide to peel off some of those winnings because you want to generate some guaranteed lifetime income, and you could increase those winnings by another 20, 30% just in the first year, and then turn on that income stream if you were so inclined. If you want more information on this, I'm going to encourage you to contact me at yourpersonalbank.com. It's the best time in my career over 25 years that I've seen for guaranteed lifetime income. And I've talked to various executives in the annuity and insurance industries, 40 or plus careers. They are stating this is the best times they've seen in over 40 years. This is the golden age of fixed investments. The last 2 years was absolutely one of the best times, one of the top 3, actually, periods of time to be in the stock market. That's a statistical fact. If we get a third year of a 20% return that or more, that's never happened before. Another article here states the mother of all bubbles in the U.S. is sucking money away from the rest of the world. Because the S&P 500 has gone up so dramatically, so quickly over the past 2 years, much of the money that's invested around the world has found its way to the U.S. market. I love this Market Watch article that states Wall Street isn't worried about a stock market crash, and that's why you should be. This gets into some of the more psychological reasons, getting away from the charts and the statistics and the history. This gets to the emotions of the fear and greed. Warren Buffett, who's famous for stating, be fearful when others are greedy. As this article states, stock traders have become even more bullish and complacent, and that is a bearish sign. Due to the back-to-back 20-plus returns on the S&P 500 over the last 2 years, many people have gotten lulled into a sense of complacency or even irrational exuberance, thinking that this is going to continue. I was watching a well-known political commentator today sharing how he had met with his financial advisors. You could just tell he was literally over the top, giddy with excitement because of the returns that his investments have done for him over the past couple of years. That's when you want to be most concerned. He was making statements that where it's you need to get involved. It's incredible. This has been awesome. I'm not a financial advisor, and I probably could get in trouble for saying this. I shouldn't, but it's been amazing. And then his co-hosts kind of cut him off because, well, he was getting into territory that could have caused him some compliance issues, frankly, not being a financial advisor or license or anything like that. But it was clear that he had a enthusiasm and irrational exuberance. And that's when people get burned, as Warren Buffett points out. I'm going to encourage you to stay tuned in the next segment. I've got a few more things about some of the expectations for the market. And again, some of the things that you can do to mitigate your risk to a potential correction.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. You can contact me at yourpersonalbank.com. Yes, you will reach me. Again, it's yourpersonalbank.com. So I was watching a well-known political commentator today, and he shared how earlier in the day he had met with his financial advisors, sort of doing a year-end financial review, and his excitement was palatable. In fact, you would even call it giddy or irrational exuberance even. He was so excited because the markets have gone up so much in the last couple of years, and he goes, I'm not a financial advisor, but man, you should really get involved, and you don't want to miss this. And it kind of went on and on to the point where his co-host cut him off because, and he even said, in their earpiece, they're telling me to stop because he was getting into territory that could have caused him some problems because, as he pointed out, he's not a financial advisor. But it was clear he was super excited, enthusiastic, giddy even. Folks, that's when you want to be most concerned. As Warren Buffett famously states, be fearful when others are greedy. And I've often heard it stated that if your taxi driver is giving you stock tips, that's probably when you want to get out. Business Insider article points out there's two looming risks that could spark a serious concern, according to Moody's chief economist. And he points out to a couple of Trump's proposed policies that could cause a correction in the market. Now, before I get into this, he absolutely could be the case. I don't really like to get into what could cause, what is the trigger to cause the next correction, because it's purely speculation. The reality is no one really knows. No one can tell you when, how much, or how long the next correction in the markets are going to be. But what we can tell you is there will be one. And the likelihood of one happening sooner rather than later is great due to the fact that we are at extremely high levels. We've had a situation where the S&P 500 has gone up over 20% 2 years in a row. This is only the third time that's ever occurred in the last century. We are getting into almost uncharted, unprecedented waters. We're at extreme levels no matter how you want to measure it, how you want to cut it. So you want to be cautious, or as Warren Buffett says, fearful because others are greedy. Take some of the winnings off the table. I've shared on the show many times where your personal bank can allow you to grow your money, insured with guarantees, tax-free, highly liquid. So if you want to re-engage, obviously a great option. Another I've been sharing on this show is guaranteed lifetime incomes. You can get up to a 30% bonus first year, 8% increase on your benefit amount. That's nearly a 40% increase on the money you allocate to create a guaranteed lifetime income or an income you cannot outlive. Others, if you want to wait longer, guarantee a 10% increase annually on the guaranteed lifetime income benefit. Those are tremendous increases. These are the best numbers that have been available for guaranteed income for 40 plus years. Now, I'll get into some of the reasons behind it and why. And I encourage you to contact me at yourpersonalbank.com if you'd like for me to run a comparison. I'll show you all the top companies. I have access to over 50 of them. There's no cost or obligation, and all I need is the amount you're considering investing, your age, and when you want to start that income. And I can show you the best options. But why taking some of the money off the table and maybe putting it into creating a guaranteed lifetime income, an income you cannot outlive? Is because, as this Moody's analyst states, if we get into a tariff war, that could be a big deal in terms of unleashing inflation, and various things like that. Now, again, I'm in favor of Trump using tariffs, particularly as a threat to get more balanced trade agreements with other countries, because I do agree most other countries have taken advantage of the U.S. in terms of trade for decades. That's really an undeniable fact. That's just the economic fact of the matter. And to get that back into some sort of balance, a more fair balance, is a smart strategy. Also, I've stated this on the show, and he discusses this as Moody's analyst discusses mass deportations. As he pointed out, if millions of people get deported, that is going to affect the economy in a number of ways. It will certainly affect sectors like construction and agriculture, but it also will have some benefits in alleviating some inflationary costs because these people have to live somewhere, they have to eat. Anyone who's here is competing for those items. So overall, I'm in favor of it. Don't get me wrong, but it will have some economic impact. And that's why I say there are going to be major changes with the new administration. There will be volatility. There will be change. There's going to be a storm to weather. Volatility is generally not good for the stock market. That's another reason. And this is why this Motley Fool article is probably one of the strongest I've read in a while. It states, I'm preparing for a stock market crash in 2025. And he explains that why he's acting as if there will be a market crash in 25. He's not wasting time trying to predict the chances of one. He points out, as I've stated many times, no one knows the future. U.S. stocks are certainly expensive. Some of the big names are extremely expensive. Government debt is high on nearly every large economy, and growth prospects for 2025 look weak or even non-existent. And he goes on to say, with the 20% increases, back-to-back increases in the S&P 500, if you add it all up, the S&P 500 is actually 93% higher than it was just 5 years ago. That's an incredible increase, an incredible run. This is only the third time in history that this type of increase has ever occurred. I'm not trying to be negative here. I'm trying to divorce the emotion from the facts. There's too many people that are getting an irrational exuberance. We saw this in the dot-com bubble. It's eerily similar. Been on this rodeo before. That's what I'm trying to say. Yes, it's great that if you were engaged in the market and you were in the tech sector primarily or significantly, you got tremendous returns on your money. There absolutely is no question about that. But what are you likely going to see going forward? The returns going forward are highly, highly likely to be far less or even negative. And I can even go on and state with gold and precious metals. I was far more positive or bullish on gold in particular the last couple of years as inflation was running hotter. Gold typically goes up when you have high inflation. But we have a new administration coming in soon. And if you look back at where inflation was in gold prices during the Trump first term, you will quickly see that that was not a great time for gold or most precious metals. I would not be surprised to see gold prices be lower at the end of Trump's term than they were when he came into office. Also, gold has increased over the past year, in 2024, about 30%, which is a large move for gold. That's a significant increase. I've been discussing and meeting with a number of investors, some who have invested heavily in gold and other precious metals, and are now looking at pulling out or taking the winnings at least off the table, reducing their risk to that. Because again, just go back in history, see what the Trump first term looked like, the economic policies that they implemented that time, how that impacted gold. Low inflation generally is not good for gold. And the Trump first term, had very, very low inflation and likely could repeat that again. So we have a situation where housing, the stock market, gold, precious metals, cryptocurrencies, even at all-time highs or near all-time highs. Much of this is going to have a correction. You have to be prepared for that. Reduce your risk, diversify your personal bank, insured. with guarantees, tax-free, highly liquid if you're looking to re-engage after the correction. That can create a tremendous opportunity for you. And while you're waiting for that, the money can just sit and grow safely, 6% tax-free, which for most people is 7 to 9% depending on your tax bracket. Or a combination of both, perhaps, creating a guaranteed lifetime income where you get a 30% bonus right away, 8% increase the first year. Folks, that's almost a 40% increase in the benefit you would receive just in 1 year. And you would receive that income guaranteed for life. Or let it ride longer and let it increase 10% a year, guaranteed. If you understand the rule of 72, you know that if you get a 7.2% return on your money doubles in a decade. Well, what if you get a 10% return on your money? Your money doubles in less than 7 years then. In other words, your benefit amount, the amount you would receive in guaranteed lifetime income, would double in less than 7 years. Many experts are referring to this as the golden age of fixed investments. Like what worked for the last couple of years and even the last decade because of low interest rate environment and all these other factors is highly unlikely to work in the next decade. We are in a different economic environment. And that's why I'm just trying to share the word of caution, proceed with caution, protect your downside, cash in some of the winnings if you have them, or if you have money or assets you're looking to invest, as many as these articles discuss, probably not a good time to look to invest in the stock or real estate markets for that matter, as I'm going to share here in the next segment, because of where the markets are at, again, at extreme high levels historically. And the likelihood of what's going to happen in the future is much more tepid. But Goldman Sachs and Blackrock and JP Morgan analysts, when they're predicting 3 to 5% annual returns going forward, that isn't something they like to share because that's part of how they do their business. That's part of their business model to get people to invest with them. And if all they can realistically project is 3 to 5%, that's not going to excite a lot of people. So they're not going to share that type of information unless they're extraordinarily certain of the likelihood of that type of outcome. And you have the opportunity, whether it be your personal bank insured with guaranteed, tax-free, highly liquid, to outperform even the S&P 500 over the next decade, or create a guaranteed lifetime income that certainly with 30% bonuses and up to 10% annual increases before you turn on the income benefit, which then is guaranteed for life, the amount of money you would have available to live on certainly can be much higher than if you invested it in an S&P 500, for example, particularly over this next decade, if all those analysts are correct. Wouldn't it be ironic that if you put your money in something that's safe with guarantees, you end up with more money than if you'd put it at risk? And that's the likely scenario we're facing right now. If you want more information on this, contact me at yourpersonalbank.com. Stay tuned in the last segment. I got a few other things about real estate, some government spending, and I do want to talk about some issues with health insurance companies, particularly given that the United Healthcare CEO was murdered in cold blood.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. Again, it's yourpersonalbank.com. So this was interesting. It's not that I pay attention to 60 Minutes very often, but in a recent interview, Blackstone has officially acquired Tricon Residential, which brings the amount of single-family homes they've purchased to over 50,000 homes. And they're expanding to buy 800 homes a month. Now, the point I found especially galling, this is from their perspective. They say Americans don't necessarily desire to own a home or to own a car. And he says that them buying homes is good for society. Now, I'm not certain that I agree with that statement. I also am not a big fan of government intervention, but it's no secret that in many parts of the country, the inventory of homes is limited. The pricing of homes is at or close to historical highs. And having large institutional investors buying chunks of these homes will continue to drive the prices of homes up. I like what John Burley, real estate expert, who's a friend of mine, has been on the show a number of times, states there should be two tiers. There should be a homeowner tier of interest rates. He suggests provide a 2% loan to a homeowner and a different tier or rate for investors. I think that would be a very fair way to address the issue without causing the government to have to intervene. Homeowners should have the advantage, given all the advantages in purchasing homes, and investors should have to be. Now I know should have to pay more because here's the reality: is do you want to live in a neighborhood that's full of investor homes with rentals or one where it's homeowners? The answer is obvious. And for many Americans, their home may be their largest asset they own. And it does provide a sense of security and permanence if a family owns their home versus renting. Now, the Street has come out with a recent article pointing out that Americans buying houses may see major housing cost changes in 2025. And they point out primarily to the inventory, as Realtor.com recently released its 2025 housing forecast. And it states that there may be some relief for buyers who've been hoping for market movement. Now realize Realtor.com historically is very bullish on housing and prices and all that. When they point out that they think that home prices might be going down some, again, they're very reticent to share that. They're very hesitant to do so. But they are pointing out that their expectation is the number of homes available on the market in 2025 will be over 12 to 13% higher than it was last year in 2024, which would be the highest point in 9 years. And competition will likely lessen for homes being purchased because of the increased inventory. Fannie Mae has also come out with a forecast even more aggressive. They're discussing a deceleration of home prices, and they stated that 80% of housing experts in the industry now expect home prices to decelerate and even go down in 2025. This impact will be quite varied because real estate is very regional. Certainly, markets like the Southeast and the Southwest are going down more than other parts of the country because of more inventory, particularly with new home builds, places like Florida and Texas, Arizona, where there's been a lot of new home building, which has increased the inventory of homes quite a bit more than in other places. You'll see the biggest differences in those areas. So if you have been listening to the show, I get asked this question often. Would you keep an eye on the real estate market consistently? Because it's a big part of what many people invest, and many real estate investors as clients. So something we keep an eye on. So pay attention to the local regions, the markets. There'll be very different stories, but opportunities are going to start presenting themselves likely in 2025 for home buyers, that is, at least. Now, I do want to discuss this one thing. I am in the insurance business, but I am not in the health insurance business. And as I often state, I focus on life insurance, annuities, investments, basically people putting their money in, investing in these tools to get returns. Property and casualty insurance, health insurance, it's a whole different animal. It's it's the difference of like a dentist versus a doctor. Those are types of insurance where of course you pay for protection in case something happens, like health insurance, homeowners insurance, car insurance, things like that. Those are protection tools. And the challenge with those, of course, always is if you have a claim and you're trying to get paid back for the claim, the incentive for the insurance company is always to deny or reduce the amount they pay out on the claim. The less claims they pay, the more profitable they're going to be. And so it's a counterproductive productive form of business, in my opinion. It's a necessary evil. I mean, try to go without health insurance, for example. Probably not a good idea, especially if you have a major catastrophic expense. And that's why I've always recommended, if possible, not paying for insurance that covers all the little things. You really want to have major medical, the catastrophic things. It's cheaper and it covers those major expenses when you have a catastrophic event occur. But as this article points out in Yahoo News from the Telegraph, states the shady world of health insurers, and it only takes about 1 second for them to deny claims because the health insurance industry, or the insurance industry in particular, when you talk about homeowners, auto, health, they've really embraced the AI revolution, and they're able to use AI in many cases to deny claims, whether it's not in network or various things like this. This has caused a lot of concern from a lot of people, and recently, of course, the famous example, United Healthcare CEO being, well, murdered in cold blood on the streets in New York. Now, I don't advocate killing somebody. There are people that have genuine, legitimate issues with their insurance, their health insurance carriers in particular, getting denied claims that, frankly, were probably legitimate. But if you want to look at the root cause of the problem, is that all this happened because the government got involved primarily through Obamacare and with government sponsored health insurance programs, company sponsored health, and the costs have gone up and skyrocketed ever since. And the problem is there's no financial incentive to keep costs in check because the person paying the premiums is not negotiating the fees. Well, the solution is really quite simple, as it is in most cases. Government is not the solution, as Ronald Reagan famously stated. Government is the problem. See, healthcare should be completely privatized. There should be no state borders and no government-based healthcare or healthcare programs because it causes waste, fraud. If policy owners, the people paying the premium for the policy, were then also the ones that would receive the benefits and have to file the claims, then the free market would take over. People would buy the policies that were the most cost effective and had also at the same time had the best history of claims. You see, if you work for a big company in United Healthcare, this is how it really works. I'm going to pull the veil back a little bit, just like in The Wizard of Oz when they pulled the curtain back. Most of the time, you work for a large company, let's say, or government agency, whatever it may be, and your health care is being provided by the company or agency, there was an agreement or a contract between your company and the healthcare provider. And even though much of this is not legal, there are financial kickbacks that occur that are negotiated by the folks making the decisions. Now, I'm not blaming or accusing anyone in particular, but I have seen it in the industry firsthand when I was 25 years ago, when I actually started early on selling health insurance to small business owners. I only did it for a few months because I quickly saw the corruption in the industry. It's because you have people negotiating contracts with large groups of people. Let individuals shop and purchase their own insurance. The corruption would get out of the system. The extra cost, waste, and fraud would also be eliminated for the most part from the system. That's the solution, folks. Free enterprise, less government, less large company interference. That's when you get into problems, no matter whether it's government spending, waste, fraud, in health insurance, you name it. Let individuals take control of their lives. Let them negotiate and shop around, and free enterprise and competition will take over, and efficiency will immediately come into the system. That's the solution. I'm just going to finish up again with what I started at the beginning of this show, is that this is the best time in over 40 years for guaranteed lifetime income. If you don't have a pension or want to create a income that you cannot outlive, there's never been a better time to do so. Once you lock in, it doesn't change your income. You cannot outlive it. It doesn't change. It doesn't matter what the economy does in the future. You cannot outlive this money. There are A-rated companies that will offer up to 30% bonus up front on the money you contribute for a guaranteed lifetime income benefit. So you can increase the amount of money you're going to receive by 30%. They'll roll it up by 8% a year. So just in 1 year, you have almost a 40% increase on your money that you're going to receive guaranteed for life versus not doing this. Or if you want to set something up where you want to defer the income for a while, you can let it roll up at 10% per year, which means the amount of money you would have available guaranteed for the rest of your life would increase 10% per year. That's significant, folks, and much, much higher than the likely returns you're going to see in the next decade, whether it be the S&P 500, real estate, cryptocurrency, gold, or any other investment for that matter. So if you're looking to create a guaranteed lifetime income, contact me at yourpersonalbank.com. As always, stay tuned to the Your Personal Bank Show. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.